Today, we will talk about the definition, examples, and pros and cons of a like-kind exchange. A like-kind exchange is a tax-deferred transaction that allows for the disposal of an asset and the acquisition of another similar asset without generating a capital gains tax liability from the sale of the first asset. Prior to 2017, this could include the exchange of one business for another or tangible property for another. But after 2017, it applies to the exchange of a business or real estate investment property for another property. When commercial or investment property is sold for a gain, the investor is required to pay a capital gains tax on the profit earned. However, Section 1031 of the Internal Revenue Code exempts an investor from making a tax payment on a gain if the proceeds from the sale are reinvested in a similar property of equal or greater value as part of a qualifying like-kind exchange. There are several important considerations to keep in mind with a like-kind exchange to ensure that a tax liability is not created upon the sale of the first asset. In addition to the tax deferral benefits, a like-kind exchange allows the seller to defer their depreciation recapture and avoid state taxes on the exchange. For example, some states require that either a buyer or seller pay state income taxes when a property is sold, but property transferred in a like-kind exchange can receive an exemption. The most glaring benefit of a like-kind exchange is the favorable tax treatment. However, taxes are deferred, not eliminated, and if the exchange does not take place within the prescribed period or according to IRS rules, the transaction will become taxable. A like-kind exchange is ideal for a business owner or real estate investor looking to sell an asset and acquire a similar one while avoiding capital gains taxes. There are specific forms that must be filed with the IRS and specific reporting requirements depending on the terms of the exchange. The third-party intermediary fulfills documentation requirements and ensures that sales proceeds are held until the exchange is complete and that the exchange adheres to IRS guidelines. For a successful like-kind exchange that straddles 2 years, the taxpayer will report the transaction on IRS Form 8824. For a failed exchange, the taxpayer may be required to report any gains under the installment method. A loss is not realized until the transaction becomes taxable. Under a like-kind exchange, capital losses are tax-deferred just like capital gains are. A like-kind exchange offers favorable tax benefits to those who qualify. Taxpayers can continue to defer capital gains tax indefinitely and have no limits on how often they can perform like-kind exchanges. Despite its benefits, taxpayers must be aware that losses under a like-kind exchange are deferred and taxes are not avoidable. Here are 4 key takeaways. 1. A like-kind exchange is used when someone wants to sell an asset and acquire a similar one while avoiding the capital gains tax. 2. Like-kind exchanges are heavily monitored by the IRS and require accurate bookkeeping to ensure that no tax penalty is incurred. 3. Savvy sellers can use the like-kind exchange to defer other specific types of gains, such as depreciation. 4. Taxes under a like-kind exchange are deferred, not eliminated. Hope this would help. Thanks for watching.